Welcome back, everyone, to week 8. We have now spent 2 months together on this journey. Time really does fly when you're having fun, doesn't it? If you listened to the last episode on passive investing and robo advisors and all those cool stuff and think that they're all really boring and that you prefer to put in the time and effort to learn about the stock market, I'll give you some ideas on where to start today. First, stock markets trade every weekday, and there is an infinite amount of news about them coming out, about the markets and individual companies in it. It can be hard to keep on top of things, especially when you have a lot of stocks in your portfolio. There is a lot of higher level debate going on about how many stocks you should have in the perfect portfolio if they do exist, and depending on who you ask, that number ranges anywhere from 8 to 50 stocks. That's 50 with 50. But imagine how much time and effort it takes to keep track of what's happening with all these companies. Because without a doubt, the stock performance over the long term is tied to the performance of these companies and the decisions they make that impacts how much money they're really making. And if you remember from earlier podcasts, we are investors and we only really care about the long term. But picking good stocks doesn't have to be as complicated as people make it out to be. Sometimes luck does play a big factor in addition to your skills and experiences. Another big factor, kind of related to luck, is the general stock market condition at the time that you're investing. Sometimes when the stock market is very optimistic and has upward momentum, even the stock price of bad companies can rally up really fast, and vice versa. But today I want to discuss picking stocks based on qualitative factors. These are descriptive factors that do not involve any numbers at all. So if you hate math, this is the perfect episode for you. Investopedia is a great online resource. They explain all this. All you have to do is go on my blog, link is below in the description, and I give you the resource link to the page of Investopedia on qualitative factors and analysis. But in a nutshell, qualitative factors you want to look at before buying the company of a stock is 1, its competitive advantage, and 2, its management. Only these two things really matter. A little bit of thinking, internet research, and looking around at all the products and services you buy around you can tell you a lot about these factors. Do you watch a lot of Netflix? Guess what? If you invested in Netflix stock when the company first appeared on the stock market in 2002, you would have made about 300 times your money. Yes, that's 300 times, meaning every 1,000 bucks would get you an eye-popping $300,000 today. These are big figures, and there are lots of other budding companies around us which might become the next Netflix, Apple, Nike, or something else. And if you know a certain industry or market really well, then finding the next superstar company and a stock in that space is something you can possibly do. So coming back to the competitive advantage, what is that anyways? Well, it has to do with the business model and industry and market. Having a competitive advantage means that the company can dominate its industry and the market. It has products and services in these markets, and it is the best seller or the highest seller. To see if a company has a competitive advantage, you have to look at what the competition is and what it does, and how the company you are investing in does it differently and better. Think about why so many people buy Nike or Adidas shoes over other brands. Think about why people buy Timmy's, maybe only Canadians will get this reference, over Coffee Time, Second Cup, or even Starbucks. Think twice about the company whose business you're putting money into, and does it really have a competitive advantage? The next thing I mentioned was management. Now, management has a lot to do with the people in charge of the company, in other words, its executives. You can do an internet search on their histories, their personal and business history, see if management includes people who have a track record of success in the industry. Bad leadership can ruin a good company and run it into the ground, and vice versa. Also, think about the company and leadership and if they care about its investors. Think about whether management really cares about its employees and customers. Can it keep them happy? Think about in the past, has management made good business decisions and changed with the times, coming up with newer and nicer products and services? These things will give you a good idea of if this company has good management and if it's worth your investment. Some managers have become famous for these skills, such as Steve Jobs from Apple or Jack Ma from Alibaba. You may have heard of them before. See if you can find the next star manager and invest in their company. With that being said, I hope you'll come back next week as we look at the quantitative factors to consider. Yes, we will be looking at some basic numbers when picking stocks to invest in. Cheers for now.